I am back. We have another deal under contract in Nashville, Tennessee. And we have my partners here at Compass Capital, Sam Frower and Michael Whiteley. These guys are my good friends from college as well. We've built up the relationship over the years, just had conflicting interests to partner up together. But now this year, since I'm going off doing my own ventures, we're partnering up this year on our second deal together. And why don't we do an intro with the team? So, Michael, why don't you go ahead and introduce yourself a bit?
Sure. Yeah, my name is Michael Whiteley. I have been in business for about the past 8 years or so. I started in the Amazon e-commerce space, made a few businesses that way and sold those. And then during that time, I learned a lot about multifamily investing and started Compass Capital about 2.5 years ago with Sam, and loving it ever since. I'm also married about 9 years, and we have 4 kids together. So excited to get into this with you guys.
Okay. Thanks so much, Michael.
Awesome.
Yeah. And Sam, why don't you go ahead?
Perfect. Thank you, Sean. Yeah, very excited to be working with you on this second deal together. A little bit about me. My name is Sam Frower, managing partner alongside Michael of Compass Capital. My background in the real estate world is I worked at a REIT, a real estate investment trust in Utah, where I'm from originally, alongside Sean, a couple $1 billion AUM REIT, where I learned the ins and outs of the multifamily space prior to founding Compass with Michael. So we currently have about $80 million of assets under management, about 500 units, all within the Nashville MSA. And we're very excited about this opportunity to be adding to our portfolio. This is looking like a great one. A little more about me as well. Married, few kids, 3 kids. My wife would like it if we added to that number. We'll see soon. But live in Southern California, maybe Nashville soon, actually. And yes, very, very excited about this deal.
Awesome. Thanks so much, Sam. And for those who don't know me too well, I'm Sean Taggy. I used to be the partner and COO of Memphis Investment Properties, which was a turnkey flipping company where we bought, renovated, and sold over 1,500 single-family properties to investors across the country. That was over a 6-year span while I lived in Memphis, Tennessee. Also, I was a part of Southern States Apartment Group, where we bought, renovated, and sold some of over 600 multifamily apartment doors. I also consulted for a property management company for 4 years that managed over 3,000 single-family and multifamily doors. And a little bit personally about myself. Sean Tagg, I got 3 kids, beautiful kids, 8, 5, and 1. Been married 10 years, and just recently moved back to Salt Lake City, Utah from Memphis to buy a business. I'm actually under LOI to buy an HVAC business. Fingers crossed that goes through. It's been a bumpy ride, like anything that's worth doing and hard, right? And also. We're syndicating multifamily apartment deals in Nashville. So we just did a previous deal called the Easton Apartments, 206 units in northeastern Nashville, about 15 minutes north of downtown Nashville. And we're actually closing that right now, in the works of getting that done tomorrow. So lots of busy work going on. So of course we'll get bored. So we have another deal lined up for you. So we're pleased to announce we have another deal for you. And let me open up the slides here. So the announcement is it's the Flats at Nolensville apartments. So it's a multifamily investment opportunity. So here's disclaimers we have to have up here for our lawyers. Obviously consult with your financial advisors. Nothing is guaranteed here, and do all those things. Feel free to read that at your perusal. So a brief overview of the Flats at Nolensville is we plan on holding it for about 5 years and have about a 2 times equity multiple, meaning if you put in 100,000, we plan on in the 5 years doubling your money in those 5 years. We project around the cash on cash return, so the cash flow each and every year, to be around averaging 7 to 9%. And then the projected IRR is around 16 to 19%, depending on where the cap rates and the rents land in the next 5 years with our conservative projections. So this slide, the projected returns, I like showing this. So if you invested $100,000, as it shows over here, and you can proportionally divide that out to whatever else you plan on investing, your cash on cash return in year 1 would be around 5 to 6%. That's because the first year it's not as great of a cash on cash return because we're raising the rents and putting a lot of money into the renovation. But years 2, 3, 4, and 5, the cash on cash return goes up a little bit every year because our rents are increasing. We're executing on the business plan of the renovations on the property. And so we start getting better and better cash flow with what you've put in on your return. So it'd be around $6,000 to $10,000 a year distributions to you based on that 100,000 investment. And that's just one part of the investment. The other returns are from capital from selling. So obviously we get cash flow and then appreciation. So as we raise the rents, that's really going to force the appreciation on this property. That's what I like about multifamily properties is it's not based on like a single family property on if the wife likes it, right? Or if it looks pretty. An investor's buying it. So if the property's performing, the rents are increasing and the profits are higher, they'll pay a higher price. So that's how we're going to force the appreciation is through some renovations, which we'll discuss further on. So around 75 to 95,000 on top of that at closing would come back to you, plus your initial investment of 100,000 in year 5 when we sell. So the cumulative profit is on that third column there, showing the cash flows plus the appreciation. So that's year 5 is showing kind of what those returns are. And then that very bottom column there, row, excuse me, is the total return on your principal over the 5 years. So 214,000 to 239. So even above a 2x return on this. So I'm really excited about this deal. It's solid. It meets all of my hurdles of like what is worth doing as a good deal. We have a big buffer in case things go wrong. We still can make a good return even if we make just half of this. And so yeah, and it can even get better from there. Obviously, we put in conservative projections and everything like that. Here's a few pictures of the asset currently. So it's already a pretty well producing asset, and that's why we already have a good 5 to 6% cash on cash return the first year. It has some great amenities, which we'll dive in further. And yeah, it just looks like a great property. It just can use some updating, which we'll dive into more. So 205 units. It's a value-add multifamily. There's the address, 5319 Nolensville Park. It's about 15 minutes southeast by Laverne and a little bit east of Brentwood, Tennessee. So Brentwood is an amazing area. And then, so this is kind of like right in the middle of there. It's still a working class area, but it is on the fringe of a really expensive, nice neighborhood.
Awesome. Thank you, Sean. And I am happy to, like Sean said, we're really excited about this one. The asset is, we're assuming a loan, which is really nice. We'll dive into a little bit more of that. But because of that, the cash flow already starts out pretty decently strong. And then we get to jump into more cash flows. We actually, only about 17 of the 205 units have been renovated. So we get to jump in the first 2 years and renovate those units and really drive up the cash flow. So we'll share more about the business plan shortly. Before we do, would love just to talk a little bit about why Nashville, right? For you investors who invested with us on our last deal, which we're really excited about, this may be a repeat for you, but there's a reason why we could invest anywhere in the country, and we're focused in on Nashville. That PwC, one of the biggest consulting firms in the world, in the Urban Land Institute, they choose the number one, they have a massive publication they do every year for real estate investing. And the number one city to invest in the entire country, they've never had it be the same city 2 years in a row. It's been now Nashville 3 years in a row, that they just call Nashville a supernova of growth. And so we get very excited that we can buy apartment buildings anywhere in the country, but buying somewhere like Nashville where the growth is just phenomenal and it's very landlord friendly, business friendly, millennial friendly, just population exploding sort of place, that there's a lot of, we don't include any of this in the numbers that we present, but our hope is, hey, this is a good deal even if it was in the middle of nowhere, Alabama. But because it's in one of the fastest growing cities in the world, there's a good chance that things could be even better. So just at a very high level, we'll obviously share this deck with you, and so you can take a look. But there's just a lot to love about Nashville. As I mentioned, number one place for real estate prospects, number one for metropolitan economic strength, second strongest job market in the country. Oracle, for example, one of the biggest tech companies in the world, is building a 64-acre campus at over $1 billion development with 8,500 employees that they're bringing in. That's already mid-development. You can see a little bit more about it here on this slide. The city of Nashville just announced they're partnering with the Tennessee Titans to be rebuilding the stadium, a $2.4 billion stadium that the city is actually paying over $1 billion of that, which is the most money a city has ever paid for an NFL statement or an NFL stadium ever. So we see Nashville just being all in on being very very growth oriented. So we like all of that. Again, I'll let you browse through these slides, but to go through them quickly, you can see that this slide talks about all the different jobs there. This shows all the different transportation and it just being a hub of an area in the country where a lot of things go through. We really like this employment by industry because we're not just like a one-trick pony town where if one part of the economy goes down, there goes the entire city, that they're very well distributed of the types of jobs that people have. So it's very recession resistant. Again, just going into this next slide, the top companies and the employers that there are. This also showing the Nashville demographics. This next slide, just showing the cost of living compared to what you're getting is pretty phenomenal compared to a lot of different cities in the US. And then these last two slides talking specifically about Flats at Nolensville is we're about 10 minutes south of downtown Nashville. So we really like this because as Sean mentioned, it's right by Brentwood, probably the nicest area in all of the metro MSA of Nashville. We're very close to major employers, to hospitals, major retailers. We're close to the airport. That this is just a very, you can see here in this slide, it shows all these different amenities, businesses, places that you're able to go that are all within a few minutes of this apartment complex. And here's another view of it from a bird's eye view of all these different amenities, very B-type location, which we like. We'd say that this is a workforce type housing asset that we want to bring up to this B-type asset for these tenants. And so that's what we'll be looking to do. And the area for this is just the perfect area essentially for this type of value add play. So that's a little bit about the overall Nashville area and a little bit about specifically Flats at Nolensville, that area as well. And I'll let Sean talk a bit about the business plan.
Awesome. Thanks so much, Sam. So the business plan, obviously, I love that Sam dived into a big part of it is where you're investing, right? Location, location, location. So we know the city of Nashville is great. And then also this submarket in Nashville is amazing. I have one of my larger investors that I'm good friends with who lives in Nashville. He actually has an apartment right nearby this one, and his rents have been just growing like crazy. He's owned it for about 8 years. And he's saying that our rents are actually low on our projections. So that's good, number one. And that this area is just growing, right? Anywhere within 15, 20 minutes of downtown Nashville, because the downtown core rents are $3,000, $4,000 a month for a 2-bedroom.
Yes.
So here they're getting a great value, but then they're still close to downtown. So he's saying rents can be $2,500 a month, in a few years or several years. Obviously, that's just
we're projecting, for example,
Yeah.
our 1 bedrooms and 2 bedrooms. We can dive into it a little bit, but we're very conservatively saying we're getting to like $1,400 and $1,700. But to your investor's point, what probably could happen in this area, again, we don't like to present the deals as such because I'd rather say yes, under promise, over deliver. We really believe that could happen, and we're seeing that happening, but we try to be very conservative in how we present.
Yeah. So anyways, with the business plan, the 3 cores of our business plan is our property manager. So we have a great property management team that is local and manages thousands of doors nearby in the area. And they've already performed on the 3 or 4 other assets that Compass Capital has over here. And so we just get in a good management team, and it's to the basics, right? We answer those phone calls. We make sure to screen our tenants and let them know quickly if they're approved or not. We just make sure the property is looking good and clean. We're going around getting to know the tenants, trying to create a community feel. Also adding in nice technology, so it's just simple and easy to pay. They can just be on auto pay and go from there and see their ledger and where they're at all times. The next thing that's really big to the key to this is our property improvements. What we like about this also is that the property management company has a sister company, renovation company, along with it. And yet again, they've been able to hit budget on the past 3 other renovations that we've had, which is really amazing. And so they stick tight to what they do. They buy materials in bulk and everything like that. They have crews that are paid hourly and they manage them very well. And so this helps us to keep our budget precise and accurate, but then also maximize what we're improving to where we're getting the most return on investment for every dollar we're putting in on the renovation. So we plan on putting in around it's around 2.4 million, so 2 million plus in the budget. A million of that will be on the exterior, and then the rest will be on the interior, which we'll dive into in more detail. And then the third part of the business plan, of course, is to increase the net operating income and reduce expenses. So our biggest play is increasing the rents, as we'll show here later on, how we can do that and how we actually have proof that this can work. And then obviously improving other sources of revenue. So we have a RUBS program. It's where we charge the water bill to each tenant proportionally. So that way, us as the owner, the landlords, aren't responsible for the water bill. It also kind of keeps the tenants responsible for keeping the water down and all of that. And then also we run it very efficiently. So we watch that P&L, and we have a call weekly with the property management team to make sure we're hitting our budget and everything like that. So one thing we really like is that we are assuming the loan. So the sellers are letting us assume their loan, and they have a 4.88% interest rate. Now that wouldn't
Fantastic.
excite me. That wouldn't excite me a
Yeah.
couple of years ago, but right now
Yes.
that is very exciting because 6% is what you're kind of getting, high fives. So
Mhm.
4.88 is amazing. It's a 5-year loan with 5 years of interest only, 30-year amortized loan, a Fannie Mae agency debt. So a very, very sexy debt in this day and age that we're assuming over. So the sellers just refinanced the property. And so we're just going to assume that loan. And then we put
One
on.
thing I'll mention too,
Oh, go ahead.
Sean, with that, and what gets us excited about this deal too, is that the seller is in a bit of distress. That they own about 30,000 units, and 15,000 of those they bought in the past 2 years at really high prices, with a high leverage and with variable rate interests that have all gone up. And so now they're trying to sell their properties that they bought prior to 2 years ago, basically just to have whatever cash they can to keep their company going. And so this is an example of that they've had this deal for, I think, 3 or 4 years now. And when they refinanced it initially, the plan was just to continue to hold it, but they're now needing to sell. And as a part of that, when they refinanced it, the property appraised at $34.5 million. And 4 months later, we got under contract for it for less than 30.5, or at 30.3 million. So we get really excited too that we feel like we're getting a from just the price of the property, we're getting a great deal.
Yeah. Yeah. So it's a distressed seller. I don't think this is a distressed area in any way or a distressed
No, it's just the
asset.
seller.
It's
Mhm.
95% plus occupied. The rents are great. Nashville's still holding very strong. Yes, rent prices have dipped a little bit, and we're coming in and scooping up on that opportunity before they start boosting up again with how rents are raising and inflation is going to keep taking over for that. So, and yet again, we put on a conservative underwriting and assumptions. We've used very conservative rent increases and cap rate upon exit. We've used what CoStar uses for the projections on those to help us out a lot because, it would be great if I could tell you I have a crystal ball to tell you what everything will be in 5 years. But instead, I put what would be great, and then I put, hey, let's put something conservative on there and use that as what it is for the future. So here's the sources and uses. As Sam mentioned, it appraised for much more than what we're buying it at right now because this seller literally needs just as much capital as they can to stay afloat on the other ones that are on variable debts that are probably at 7% interest right now on some of them because they're.
Yep.
And so it's just worked out well for us. So we got it for 30.3 million. So that's the purchase price. Operating capital, that's to help start with the renovations and also have a reserve fund for anything that we need. Capital improvements, as mentioned, around $2.247 million in renovations, which we'll dive into more on where exactly that money's going into on the property. And then $1.7 million in closing costs, a lot of lender fees, title fees, everything like that, an acquisition fee for ourselves are tacked onto there. So total uses is 34.555 million. And then the sources will be the debt financing, which is the loan we're assuming to help pay for this, 23,660 million. And then our equity investments, that's how much money we're raising. Ourselves at the general partnership is putting in at least 5 to 10% of that equity investment, if not more. We obviously just save a little cushion for depending on how many investors come in on the deal. And then we'll raise the rest of the money with investors like yourself who is watching this video. And then also some other other contacts that Sam and Michael have built up over the years of big, more private equity offices that are located in New York, Florida, and California that they might be putting in. And I don't know, Sam, if you want to talk a little bit on that, on kind of the prospects on that.
Yeah, happy to. So we have investors in a variety of different places that we're actually looking at a nonprofit who's really interested in the Nashville market, putting in a few $1 million. We've got a few family offices that like to write seven-figure checks, and then we have other partners like Sean that bring in capital alongside us and put the money that we need together for the deal for us to be able to run it.
Yeah, so I think that's amazing for most of my investors that I'm familiar with. I mean, you guys are putting in 100,000, maybe 500 or a million at the most. And so, like, look, guys, you're investing alongside big, smart money that they're investing family offices, they're investing, nonprofits, 50 million, $100 million a year sometimes. And they
Mhm.
have maybe even $1 billion assets under management sometimes, or hundreds of millions. So if they're picking this deal alongside you, you're getting this sneak peek into sliding in a bit of what you're putting into the deal and investing alongside really smart money that they just know this is where all the big people are putting it in, is in real estate and in businesses. Is
Yeah, you may
where
have heard the term institutional capital before that.
yeah.
That's where all the big dogs play, and this is the sort of things that they invest in. So it's exciting for us to be able to bring to the regular people like us, like you, the chance to invest in these same deals that these institutional fund private equity groups are investing in these same deals.
Yep, exactly. So yeah, I just think it's a great opportunity to check out and jump in on. So here's the timeline on the property. So the first 2 years, the property is already very occupied. So as leases expire every year, we'll start turning over the renovations on the interior of those properties. We'll communicate with the tenants months before their lease expires to give them a heads up, like, hey, guys, we're coming in. We're going to raise rents. Whether you can stay in the property and we're going to raise rents because it's already below market, or you can move into a new unit that's fully renovated, or we could raise your rent a bit more and fix some things that you're in need of, right? Or maybe even move you out for a week and fix your whole property, and then you have a nice property on the inside. So that's what we communicate. We try to do that as courteously, and as friendly as possible for these tenants so that they can have plenty of heads up, and then also give them options and let them make an informed decision of what they want to do. And what usually happens is they kind of go, oh, the rent's going to increase $190 a month. That's typically what it is. And they go, no way, I'm not. But then they go and go to 5 other properties and they see, oh, that is what the rent is in this area. I'm just kind of a little bit under rent. And then they go, okay, I'll move into a new unit that's fully renovated and take this higher rent because I like this area. And they also see that we're renovating the exterior. We do that right at the beginning to just show them, hey, there's a new owner, there's a new sheriff in town. We're ready to take care of this property and really add some great value to the tenants, not only on the interior, but the exteriors of the property as well. And so as we phase out and do all the units, the 205, 17 of them have already been done, and we'll go into more details on that. So the remaining we'll do over those 2 years. So then years 2 through 3, we're going to have continue stable operations and just start watching the market and pushing rents up. And we do it by the $5 amounts. Like, we're trying to get, like, kind of like the airlines, right? You know how airlines, like, oh, supply and demand, those prices are changing all the time. We're checking out our prices weekly, looking around the market and seeing how much we can tack on just a little bit more on the rent to maximize it, but also give a good fail value to the tenants so they stay long. And then, of course, focus on cash flow and have our meetings with our property management company and just follow up with them on everything like that. So there's the timeline. And then we plan on selling in years 3 through 5, depending on market conditions. We put in our pro forma on year 5 because that's the most conservative timeline to put it. If we sold earlier, the returns would be even higher because you get your money back quicker. So your IRR would be higher.
Awesome. Thank you, Sean. I'm happy to dive into specifically what we will be doing at the property, both inside these units as well as the exteriors that Sean was just speaking about as well, to say how can we justify that we're going to be able to bump the rents up $150 to $200. So on the unit renovation side, as you can see, 17 units have already been renovated. We still might put in some premium. We've got a little bit of money, right, to put in some premium, maybe like a smart home or update the lighting or something just to give it an enhanced feel. But what we get excited about these 17 units that have already been renovated they're getting the rents that we're projecting. They're getting the rents that we're trying to have for our business plan. And so this is something you don't always get, that like often you're going to the competitors, which we do as well, to see what their rents are and say, okay, we can do the same thing at our property. This buyer who we're buying the property from has already proved out our business plan, that they're getting the rents that we're looking to get as we renovate. And so it's really just continuing to do what they have already done. So we'll be adding in, again, for this workforce type housing group, we'll be adding in from these older white appliances, like for the fridge, for the oven, microwave. We'll be adding in updated black appliances, taking out the carpet, putting in vinyl flooring, updating the cabinets, putting in granite style countertops, redoing the paint, the lighting. We'll really be making these look and feel a lot nicer for not a crazy rent jump. We get excited about that too, that some value add plays you have are like $400 or $500 a month more in rent you're trying to get. We're just trying to get $150 to $200 through renovating a month through these rents. And there's a good chance too that with that jump not being massive, that there are tenants who will want to stay even in their existing unit. We obviously will renovate it when they leave, but we may be getting these rent bumps with some tenants without even needing to renovate the units at first, just because they're, like Sean just said, it's the price that the market currently is at. And so going anywhere else, they're going to have to pay for it anyways. And most people like to continue to live where they are. So we get very excited about what we'll be able to do with the interiors. And then on the exterior as well, right? That this current owner has not done a great job of taking care of the property. And we know how much that curb appeal matters. So we're completely overhauling the look and feel of the outside, that we're going to redo the asphalt, have brand new asphalt that people can drive on. We're going to be adding in a new playground. Their playground is old and run down. Be updating their dog park. We're going to add, it's really dark at night, so we're going to add in a bunch of lighting and a security camera system just for people to feel safe. We're going to resurface the pool. We're going to add right by the pool or in the pool area, like a cool outdoor kitchen with a pergola. We're going to repaint the whole exterior just because it looks kind of old and tired. We'll update the signage. We'll update and put a lot of money into the landscaping, just really overhaul the look and feel of this property. And again, they're already getting the rents that we want, and we're doing all of this extra work. Like there's a good chance that we could be bumping the rents even further, but we just want to be conservative in what we're initially projecting for investing. And you can see here just this little laptop screen. This is going into, as mentioned, the numbers for what the money is going essentially for our capital expenditures. So you can take a look at that and see the breakdown of where this equity is going. And I will let Sean talk a little bit more about both just a quick overview of the property details itself, as well as the unit mix and the comps.
Yeah. Thanks so much, Sam. And yeah, that's I love that we've already proven the business plan on 17 units. I mean, it's a no-brainer. Like it's always that scary, those first 5-10 units you renovate and you put them out at the higher price and you're like, oh, hopefully the market sustains it. I mean, the data showed it. We did our research, but does it really work? And this already shows it. We've already done it on 17 of the units the previous owner has, and we're actually going to do about 10% better renovation than what they're doing, plus the exterior as well that they don't even have done. And then another thing I want to mention about the property manager is they came to the tour and the due diligence. They're working hand in hand with us, and we're driving this. We're paying attention to every detail. We drive it multiple times a day. We get a feel for the whole area and all the other comps. And they're helping us too, suggesting about Michael and Sam and everyone. The whole team is collaborating together, and that's where we thought about, hey, it looks a little dark at night. If I were a mom, walking my kids in, I kind of want that a little brighter. And so just those little details like that, we're really trying to focus on to make this property truly amazing and showing that we care. So the property description site plan, so you can pause and read over all of this. The big things that I like in here is that the plumbing is PVC piping with these older properties like this one in particular, and then in the 70s builds. The two big things I want to know, the plumbing and the wiring. So it is not aluminum wiring, it is copper wiring. So if you have aluminum wiring, that has more potential for fires and everything like that. So this already has copper wiring, replacing it years ago. And then also plumbing is good. And then the third thing is the foundation is looking good as well. So those are like three key things that I look for. And not necessarily means it's a deal killer, it just means, hey, we need to get a good price on that. And so yeah, there's the site plan and everything like that on the property. So the unit mix. So the property is mainly 1 bedroom and 2 bedroom, 1 bath apartments, so 95 and 86 respectively. And then we have 24 3-bedroom, 1.5 baths. So the average square footage is 870 about. And then our average rent currently is around 1272. So a big thing obviously is, right, to execute our business plan is like, where is the market at? How much can we raise these rents by? And is that really feasible? So what we do is we've driven every single one of these properties and then some even more, and obviously have other properties nearby from other investors, and we're talking around and getting a feel for where we can put rents. So the Flats is our subject property on the bottom. And so you can see our average rent for the 1-bedroom apartments are well below the other 3 properties nearby that are the most comparable. So as you can see, they're all built 1970s. One is 1981, and ours is built in 1979. And so you can see they're very close. I mean, they're just a golf swing away for some of you great players. And our square footage is in line, but yeah, we're just well below. And a thing that shows me as well is that our occupancy is really high. Now, you might think like, oh yeah, great, we have the highest occupancy, but that also tells me maybe a bit we're not pushing rents just quite enough when it's super, super occupied like this one. And it kind of shows here. So yeah, we feel we can raise rents around $200 a month feasibly from this rent comparison analysis here. And then the same thing for the 2-bedroom. So we're now onto the 2-bedroom apartments and the 3 subject properties. So as you can see, our average rent is $1360, where the total average is around $1585. So yet again, $150, $200 a month, we feel like we can easily raise the rents on. And similar build and vintage with the comps nearby as well, and square footage. So I really like that. And yet again, another thing is I'm kind of a data guy. I like data and numbers. And so, a lot of people kind of be like, hey, Sean, don't just pay attention to data. And I've realized that over the years is like, you actually, number one is like, yes, there's the numbers of the rents, but then you got to really go and look inside each property and see the amenities, the feel, the exterior, the landscaping, and just check out the floor plan of those properties. And our property is on par with all these properties nearby. It's that sometimes, you can deceive yourself in the rents because one property has really high rents, so you think you can achieve that, but they might have an amazing gym or something like that your property doesn't have, which would cost you $1 million to put in. This is not the case in this one, but just stuff we've been looking in and the details we pay attention to.
Awesome. Thank you, Sean. And happy to, speaking of the numbers too, being very important, right? Our underwriting and diving into why we believe this opportunity is the opportunity it is. We can take a quick look at our pro forma. If you look at this page, again, a lot of numbers going on. If any of you have questions, happy to follow up with either myself or with Sean or Michael. We can dive in more to this, but essentially saying, here's why we believe this deal is what it is. From the past properties we own in Nashville, from understanding the market, from our property manager, that we've honed in, right? The rents that we can expect, the expenses that we're expecting. Again, you're seeing this over a 10-year hold. Our plan is not to hold it that long. We're looking to sell in year 5, but just to give you an idea, right, that we're projecting out both from an income and an expense perspective of what this property really can do. And I also really like, again, just because we're trying to be super conservative, if you'll look at the year-over-year income increase, it's right in the middle of the page, that in year 1, you can see that our income actually drops almost 2% from what the property is already doing. That's just us saying, hey, we're actually going to make less money the first year than what the property is currently doing, just because we want to be very conservative of the time it will take to renovate and to bring on these new rents, et cetera. Again, it's probably not likely we're going to make more money than they've made in this first year as we continue to execute on this plan. But just to show you how conservative we are, that we're saying, hey, we're being very cautious and conservative in the income that we're bringing in, and then rent growth, and then that growth, right, occurring in later years through the value add that we're running. If you look at the pro forma assumptions, same thing, right? Want to say both from the income, economic loss, and expense side that this is why we believe the numbers are what they are, right? So you can dive in everything you just saw on that pro forma tab. You can look at each of these: advertising, payroll, insurance, where pricing will be based off of our information of the market, our information of what employees cost, based off our other properties, the property management group, et cetera, that we have all these numbers dialed in to be able to run this property effectively and efficiently. So that's a little bit about the property as a whole. That's a little bit about Nashville, a little bit about the market around where Flats and Nolensville is, and hopefully you can see why we're so excited about this opportunity, that we're buying in one of the hottest markets in the country with an assumable loan at a great price and a very simple value add play to increase the rents in the remainder of these units. And so this is something that we are very excited about. I'd say one of my favorite deals that we have done to date. Very happy to have Sean and you all potentially on board. As we jump to the FAQ side, again, feel free to pause, but at a high level, just want to run through, this will be a 506c investment. And so you must be an accredited investor, which means you make either $1 million, or you either have a net worth of $1 million or are making 200K plus a year. The minimum investment for the opportunity is $100,000 per investor. You are able to send your money in from your RIA or solo 401k funds. We are able to accept those funds. As far as timing, we are looking to close in about the middle of February. So we're already accepting money and bringing the capital in. So act quickly for this. That Sean will be able to provide a link with for you to be able to log into the investor portal that allow you to sign all the legal documents and wire the money. And as far as the profit split of how we will run this, I'd say very advantageous to most deals out there in the market to the investor. We like to keep it simple, not have complex waterfall structures or anything else. But we're saying that after you receive an 8% preferred return, which means you have to, before we make any money, you have to make on average 8% every single year, at which point then 70% of, after that's been hit, 70% of the profits will go to you, the investor, 30% will go to us as the general partners for running the deal. First, you have to hit that 8% return that you have to, if you invest $100,000, have to be getting at least an $8,000 return, or if it's lower in year one, right, it'll accrue into the next year, that you have to be getting that return before we take profits ourselves. So just to very much show you that we're very in the deals and in the trenches with you, that we make money only when you do. And to end, Sean, thank you so much for the time. I'd say now is the time to invest, that we are actively accepting funds. As I mentioned, we're already accepting wires and capital and expect to fill up quickly. So please let us know if you have any additional questions, but very much looking forward to having you on board with us at Flats at Nolensville.
Yeah. Thank you so much, Sam and Michael. I'm excited to be partnering up with you again. I've talked with them. We see each other, partnering up for years to come. We really like working together. And so yeah, investors, if you're interested, click the link in this email so you can sign up and submit your reserve on this property, and then read over the investor documents and submit your wires to get into this deal. And so great for everyone for your interest. And please feel free to email me, text me, call me anytime. I'll have a link down below. You can schedule a Calendly call with me to talk, or just email me, or whatever's easiest for you. Thanks so much. Have a good one.